Hello folks, Steve Lentz here with Discover Options here at OptionView. Welcome to this presentation of 3 different market timing reports, S&P 500 market timing reports for advanced options traders. This will be for Friday ending June 1st, getting ready for the open on June 4th. Presented material today is for educational purposes only, should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. And so if you could please hit the subscribe button. That way you'll get alerted when we come out with new videos. And also we have a free ebook for you, Simple Steps to Options Trading Success. Just click the link, give us your info. We will get that out to you. This is a book co-authored by myself and Jim Graham, our company's COO. All 3 market timing reports pertain to the current market condition in the S&P 500. And the way we do it here is we look at 3 different dimensions: price action, trend, and the stochastic situation. In terms of price action, we had a downswing bar on Thursday, followed by an upswing bar on Friday. This occurred above the 50-day simple moving average, so the market is in an uptrend. And then in terms of the stochastic, we use a 15-3 stochastic. Currently, it is between 40 and 90 and trending upward above its 3-day simple moving average, or %D. All 3 factors combined like this make for a condition, using these definitions, that has occurred 78 times since January of 2000. 78 times. And so that's the sample that we have. Let's go to the first report, which is the Condor and Butterfly timing report for the S&P 500. This is for advanced options traders who like to use these strategies, and we answer the question: is now a good time to put on a butterfly or a condor? All right, so here we go. Since January of 2000, we've had 4,630 daily closes of the S&P 500. Now, of these, 64.8% have been favorable bars for selling option premium, where the actual subsequent 21-bar movement was less than what was being implied by the option prices. And we measure that by using the SIBO's skew-adjusted VIX figure. All right, and so there's a downside number that's different from the upside when you adjust for the volatility skew. Okay, so 64.8, just a little bit less than 2/3 of the bars have been favorable for doing butterflies and condors. Now, also during that time, our condition, as I mentioned, has occurred 78 times. Of those 78 occurrences, 61.5% of the bars were favorable. Now, that's less than the benchmark historical level of 64.8. So this implies a selling edge of negative 3.3. We have a negative edge here. Okay, statistically, it's slightly more likely than normal that our current market condition will end up being an unfavorable one for market neutral option premium selling. Does it mean that you'll lose money? Well, no. 61.5% of the time, things work out fine, where the market does not move as much as what is being implied. Right, which is great. However, you could flip a coin and just randomly pick a bar, historically, and you'd have better chances than using this market condition than we have now. So you could still make money, certainly. It's just that the statistics are slightly against you by a little bit compared to just the historical benchmark level. Okay? Now, let's go on to the bull-put spread timing report. This is predicated on the notion of selling puts, perhaps a bull put, by doing a credit spread in the put, a standard deviation out of the money 30 days out. Okay, so as I mentioned, we've had 4,630 daily closes of the SPX. Of those, 82.9% of the bars have been favorable for selling put premium, like I just described, where the actual 21-bar downside movement towards those puts was less than what was being implied by the SIBO skew-adjusted VIX downside movement. Okay, so if you sell those puts a standard deviation away, randomly, you can pick any bar, just flip a coin and pick a bar or whatever. Almost 83% of the time, the market will not move down and hit that strike, a standard deviation away 30 days out. Okay, so that's the benchmark, 82.9%, about 83% of the time, you're going to be just fine. The market will not go down that far. Now, as I mentioned, we've had 78 occurrences of our current market condition. Of those, 80.7% of those were similarly favorable. That's a lower number than the 82.9 by about 2.2%. So again, we have a negative edge here. It's slightly more likely than usual that today's condition will end up being an unfavorable one for selling at that out-of-the-money put premium like that. Not by much, but by a little bit. Okay, so just want to make it clear. Right now we're operating both put spread and the Condors with a little bit of a negative edge. Doesn't mean if you did it, you'll lose money. Just means that going into it, the statistics are not quite at least where the benchmark random level would be. Okay? Finally, let's look at the market likelihood report. What we do is we take our current market condition and we compare it to just the benchmark rate of change and realized volatility levels. So here we go. Let's just go to the top part of the screen here. And we can see that we've had 4633 closes of the S&P 500. On average, the 5-day rate of change, you could take one close, look at the close 5 days later, and you'll note that on average, of those 4,633 closes, on average, the 5-day rate of change is 0.1% or 0.1%. That's because the market's been long-term bullish. The 10-day or 2-week rate of change has been almost 0.1%, 0.19, and the 3-week or 15-bar rate of change is at 0.28 or little more than 0.25% to the upside. Okay, so that is the benchmark rate of change taking place historically in the S&P 500. Now let's go to the 78 occurrences of our current market condition. All right, and it says 79 because that includes the current one, but we don't know the outcome of that yet. But anyway, when you look at the average 5-day rate of change of those 78 occurrences, the market, the average 5-day rate of change is at 0.15, which is a little bit more than the 0.1 to the upside. So that's a difference of 0.05%. That's not that much. When you go over here and look at the significance of it to see how, how much of a big deal is that, what we do is we use a z-score. A z-score tells you a percentage of a standard deviation that difference is. And in this case, it's about 6% of a standard deviation. Not very much. Not very much to the upside at all. Now the 10-day rate of change, instead of being 0.19, our current market condition, the 10-day average rate of change, 0.03%. The difference is down to the downside, 0.16. That's about 14% of a standard deviation to the downside. No big deal at all. And the 3-week rate of change is to the downside. Instead of going up 0.28, it only goes up 0.11, which is 0.12 to the downside. So that's a z-score of, that's a z-score of about 12% to the downside. All in all, no big deal here in terms of the rate of change. Okay, nothing hugely predictive. Now, what we do, though, is we carve that up, and we say, when we have that Friday's bar, the upswing bar, if on Monday the market goes above the high of that bar, that would be right here. If tomorrow price exceeds today's high or Friday's high, okay, that happened, of those 78 occurrences, that happened 55 times. Okay, the distribution of those 55 occurrences, the average 5-day rate of change of those 55, 0.54 to the upside, definitely bullish. Over half a standard deviation to the upside there. Okay, in terms of a z-score statistic. And the other two, the 2-week and 3-week, have very low z-scores to the upside, no big deal. But at least in terms of a short-term situation, yeah, we're looking, if the market goes above Friday's high, you're looking at a short-term bullish a prediction that's a bit more significant than anything we've seen here so far. Now, there were 15 occurrences where the market went down below Friday's low. Okay? And if that happens, of those 15 occurrences, the 5-day rate of change was to the downside over 1%, which is 1.5 standard deviations to the downside. That's a pretty big deal. And the 2 and 3 week z-scores were to the downside, almost a standard deviation, 0.84, and here's 0.79 of a standard deviation, about almost 80% of a standard deviation to the downside. So clearly, if the market goes down below Friday's low here on Monday, okay, you have a pretty decent probability of it continuing down. Now that's based on only 15 items, in the sample there, so that's not as big a deal. But I wanted to report it just so we kind of have a beat on where things are at. Short term on the upside if it goes above Friday's high. In terms of volatility, okay, the benchmark volatility is between 15 and 16% historically. Our current market condition results in a realized volatility between 11 and 12.5. All right, and currently the VIX is sitting at 13, almost 13.5, and the short-term VIX, the 9-day VIX, is at 11.44. So it would appear that the realized volatility that we can expect from this market condition is just a squeege bit lower than what the VIX is at. All right. And that's it's a little bit lower than what the VIX is at currently, which is kind of curious because the statistics all play out showing us a very small negative edge for selling premium. Yet just looking at the VIX like this, you wouldn't get that impression. Now, here's the thing we do, though, is in our studies, we do carve up and we skew adjust our studies in that previous Condor and Butterfly timing report and the bull put spread. We are carving up the VIX, so we have a different VIX that we use for the downside as opposed to the upside. So that could be playing into it because it's a more accurate reading than what you're seeing right here, just comparing realized to the broad VIX. Okay, I hope this information is helpful for those of you advanced traders trading these strategies. Have a great rest of the day. Have a great week. Take care. Bye-bye.